Good morning and welcome to our quarterly investment update for clients. Regular viewers will know my name is Henry Gaskin. I'm the chair of our investment committee here at SG Wealth, and you join us at a very interesting time for markets and economies, with the world still opening up just about after lockdowns, but with plenty of friction in the global economy and global supply chains due to the surging demand we've seen and the continued disruption due to the ongoing impact of the pandemic around the world. Today, I'm delighted to welcome Michael Kinsella as our guest speaker on the call. Michael's an investment specialist at Troy Asset Management, who we've specially selected to be involved this time round. Not only does Troy manage one of the key cornerstone funds within our range of portfolios, but they, like ourselves, also celebrated 20 years in business earlier this year. So Michael's going to be looking back at their performance over that time and explain how their process has helped deliver great returns for investors over such a long period. I'm sure you'll find his presentation very interesting, but before I do hand over to Michael, I thought I would myself look back over to 2001 just to help set the scene. So 20 years ago, we were in the early stages of a technological revolution that would transform how we lead our lives. Apple were a US computer company with a then market capitalization of $7.5 billion. In 2001, they released their first iPod and also the iTunes software for the first time. 20 years later, as you can see on the slide, the latest handset release is the iPhone 13, and they've turned themselves into the world's most valuable company with a market cap of $2.5 trillion. The internet, as we know it, was still a relatively new phenomenon. The first commercial broadband service was launched in the UK only the year before. Back at SG Wealth, when we opened our doors in 2001, if we wanted to access Wikipedia, which also launched in 2001, we were still using the noisy dial-up modems at the time. In politics, we had a Labour Prime Minister in Tony Blair, Republican President in George W. Bush, and Vladimir Putin in charge at the Kremlin. That goes to show that some things change over time, some things remain the same. In the world of sport, England achieved a famous win over Germany. And on the screens, we had David Brent in The Office and Harry Potter hitting the screens at Hogwarts for the first time. We also saw the world witness the tragic events of September the 11th in 2001 with the terror attacks on New York and Washington. As you can see from the chart, the global stock markets plummeted in September, and despite recovering a little, they endured a challenging year, which would extend into a slump until later into 2003. So not an ideal time to be launching a wealth management or an asset management business. That difficult chart is shown on this longer term chart now, which looks back over the 20-year period. We're showing the UK stock market in blue, the wider global FTSE World stock market in green, and the MSCI Emerging Markets Index in red. You can see that despite this difficult start for the first couple of years, all of these equity indices delivered very attractive total returns over the next 20 years, albeit with some periods of notable volatility along the way, particularly during the great financial crisis of 2008, and of course more recently with the pandemic last year. As you can see on the charts, there's a rather flatter line, orange line, which is inflation, which we'll talk about a little bit about more later on. And the turquoise line on the chart for completeness is the UK government bond index. This next chart shows the same indices over the same periods, but now includes the performance of the Troy Trojan Fund in purple. This is the fund that we hold as a core component in the vast majority of clients' portfolios. As you can see, the performance has been very successful, not only in generating really excellent returns to investors, but also navigating the periods of volatility very well. Before I hand over to Michael just to explain how and why in a bit more detail they've delivered this performance, just a quick bit of housekeeping. We are very happy and very keen to accept questions during the session. We'll be taking these via the online Zoom Q&A function. So please feel free to submit questions at any stage, and we'll take them at the end of the presentations if we can. Of course, if there isn't time at the end, then we'll get back to you after the event. But that's it for me in terms of an introduction. I'd just like to invite Michael to come onto the call and take you through his slides.
Can you see that, Henry? Great. Good morning, everyone. And thank you very much, Henry, for the introduction. Just very briefly, my name is Michael Kinsella. I work within the multi-asset team here at Troy Asset Management, supporting Sebastian and Charlotte as an investment specialist. And I joined Troy about 5 years ago from Veritas Investment Management, where I worked in the private client team managing people's wealth. I know that SG asked us to do the call because they celebrated their 20-year anniversary, and so did Troy, actually, which is quite the milestone. And we marked it in the office by, in typical Troy fashion, by drinking tea and eating Colin the Caterpillar cake. So it was quite the riot of a party. But I plan to talk for about 15 minutes on what Troy is, how it came into existence, but also with a focus on the primary investment vehicle, which is the Trojan Fund, and more recently the Trojan Ethical Fund, which I'm sure we'll touch upon later on. And all this will be wrapped up in the context of the last 20 years. So, who is Troy Asset Management, and why do we have horses all over our presentations? Troy was founded 2 decades ago by Lord Weinstock on the left-hand side, and Sebastian Lyon, and it was a vehicle to manage the wealth of the Weinstock family, which had been built up over a couple of decades. Lord Weinstock managed General Electric Company and became an industrial powerhouse over that time, and then passed the business over to new management. It had a new name called Marconi, which I'm sure you'll all remember. And in the aftermath of the Marconi crash, Troy was born. And Lord Weinstock had known Sebastian because he worked on the pension scheme at General Electric Company for a few years. But he set Sebastian the task, and he was crystal clear with it, to not lose his money. And that is how Troy has started. If Sebastian took unrewarded or unnecessary risk, the joke by Lord Weinstock apparently was that he would give Sebastian a bottle of whiskey and a revolver, and that would be it. But joking aside, that was the aim of Troy from day one. And also it was named after Lord Weinstock's Epsom Derby winner of 1979. So we have horses all over our offices as a result of that. This allergic reaction to losing money was instilled in Sebastian from day one. And so what we do is we seek absolute returns, not relative returns, to get away from benchmark driven investing and to prioritize capital preservation and then growth in that order. So 20 years ago, it was just Sebastian who was running the firm and one client, which was Lord Weinstock. And today we are 44 people, all based in London. We have thousands of investors that we manage wealth on their behalf of. We take that incredibly seriously. And we manage about £14.5 billion today. So Charlie Ellis was an investor who wrote a book in the late 1990s called Winning by Not Losing. And we compare this idea to playing tennis. There are a lot of tennis fans in the office here. But the idea is that by not hitting the spectacular shots, by trying to avoid unforced errors, by staying in the game, you can ultimately win out over time. And that's absolutely critical to the types of strategies that we manage here, both the Trojan Fund and the Trojan Ethical Fund. Ultimately, what we're trying to do is avoid torpedoes in the portfolio. And that's what we've done over the last 2 decades. So how do we do this? If you go from the left bubble to the right bubble, we start with equities. We prioritize high quality compounding franchise businesses. It's bottom up, fundamental, qualitative stock picking. If the companies that we favor are too expensive, and a lot of companies are very expensive today, then we will favor, or we're not afraid to hold inflation-linked government bonds, gold, and also cash. We don't compromise ever on the quality of the companies that we want to hold. And so as today markets are expensive. So that will be reflected in our overall asset allocation. So today we have roughly 40% of the portfolio in equities, both the Trojan Fund and the Trojan Ethical Fund. That reflects our caution, really. With regard to cash, this is an active asset allocation decision, and this is an important point because coming into the global financial crisis, but also coming into the COVID crash, the Trojan Fund and Trojan Ethical Fund had a big cash buffer, and that really put Troy on the front foot to be able to buy equities as markets fell. We really were buyers of choice, and we lean into risk as markets fall, which is really quite uncomfortable to do at the time, but it's absolutely the right thing to do to lock in long-term risk-adjusted returns. The strap line on the top that our approach is simple but not easy. We seek absolute returns, but this is not an absolute return strategy. Our industry often likes to add complexity with derivative strategies and things, but really from day one, we kept this strategy deliberately simple. So with regard to the investment track record over the last 20 years, your eyes will probably be drawn to the red lines that are falling, and they're really the down markets in years. So 01, 02, the global financial crisis in 2008, and then last year, of course. And really the philosophy has stayed the same from day one, which is Lord Weinstock telling Sebastian and the rest of the team not to lose his money. And it was in 2008 that strategy and that process was really tested. And Troy kind of came onto the map, as it were, because we had a very good crisis. The Trojan Fund was up 1 when markets were down 30. And it's importantly by avoiding these types of drawdowns that the Trojan Fund and the Trojan Ethical Fund have been in a position to compound at higher rates of return than equity markets in general. And importantly, exposing our investors to lower levels of volatility. The whole idea is that we're trying to give our investors a smoother ride and for them to sleep at night, whilst we don't really. And this is the nature of managing investors' long-term hard-earned capital, and to not lose sight of what Lord Weinstock set the task from day one. This is very much a sleep-at-night fund for investors. So this is ultimately what we're trying to do. You can see the different periods with which markets fall, and really by not falling and by preserving capital on the downside, it really sets you up to compound over the very long term, and by navigating these destructive periods of capital and impairment. So the context of the drawdown changes, but ultimately the behavior of the Trojan Fund does not. It preserves and defends. And so on the left-hand side, you can see the global financial crisis, where it was really the worst experience from the peak to the trough. If you had bought at the top and sold at the bottom, it was about 13 or 14%, whereas with equity markets, it was almost 50%. And so that's an important point to draw out. And again, we do this by exposing investors to much less volatility. It's always been kind of our view, contrary to the investment industry's kind of dogma that you need to take more risk to have more return. And we disagree. You can take less risk and you can have respectable returns. And so on the left-hand chart, it's showing you the total return of the Trojan Fund over the last 20 years has been around 320%. But importantly, the bottom numbers show you annualized volatility, which is the measurement of standard deviation, or how much the number moves around the average. And that's much less than that of the equity market. So we've achieved both higher returns and lower risk over the life of the vehicle. Sounds very easy, but what's driven this, it's not, but what's driven this is largely our stock picking, and then the balance of the portfolio in bonds, gold, and having overseas currencies. I wanted to show you this slide because it just shows that old habits do die hard. In 2006, we presented to a wealth manager in the UK, and I have to apologize for the cheesy horse logo in the top right-hand corner there. But really, the point is that there are a few things that never change, and Henry mentioned that earlier. And these are candidates for long-term thinking. Everything else has a shelf life. And so we stick to our knitting. We try and invest in businesses that have strong management teams and have high sustainable returns on cash flow, whilst avoiding blue sky investments and momentum investing. We're not contrarian for contrarian's sake. We think that's folly. And you just ask any investors who tried to buy bank stocks over the last decade, always trying to catch the bottom, that's been quite destructive for capital over time. But we tend to buy good businesses perhaps when others are looking the other way. So looking at the quote on the top of this slide, hopefully you get the message that we do deep fundamental due diligence in the companies that we invest in. We have a universe of 170 companies. We have an investment team of 14 that are piling over these fabulous businesses. But looking at the bottom of this slide, really, it's easier to define what we don't do than what we do as a starter. So we avoid companies with weak business models. We avoid companies with poor governance, companies that are cyclical in nature, companies that are highly capital intensive, companies that have excessive levels of debt. Those businesses tend to typically be quite volatile. And so think of things like BA and Volkswagen in the top right-hand corner of that chart on the right side. So what you're left with really are a collection of rare and fabulous businesses that kick off huge amounts of free cash flow generation and compound at high rates of return and are very defensive. And examples of this in your funds are Medtronic, Nestle, and Unilever. So when it comes to equities, and we've talked about our long-term ownership, long-term doesn't mean buying and holding forever. Our portfolio turnover is low, but we do change with the times. And this slide tells you that things change. And even Henry's introduction tells you that things change. I mean, even look at the iPhone back in 2001, it's crazy. But on the left-hand side, what you're looking at are the most valuable businesses in the United States in May 2001. If you'd bought all 10 of those businesses, you would have lost money in 7 of them today. 2 of which, AIG and GE, you would have lost more than 75% of your wealth. So this moving picture represents huge technological change, and there's probably no surprise to anyone on this call. On the right-hand side, you can see that 7 of the 10 names are kind of classified or categorized as technology. It's a huge shift toward digital, and it's what's powering the global economy today. The Trojan Fund, for reference, holds Microsoft, Alphabet, and Visa on the right-hand side of this chart. So Henry mentioned that we'd talk about the investments that we've done over the last 20 years, and just in the equity part of the portfolio, which I mentioned was 40%. So we started really with a high level of UK listed equities in the portfolio, but over time we've pivoted more into international equities, and really that means US equities. And there are a few reasons for that. The United States is shareholder-friendly environment. The US typically sets the financial weather. Commercial trends typically start in the United States. They've an enormous domestic market, which is 10 times the size of the UK. But importantly, the depth, the liquidity of that market, the quality of the companies we can find there. And to be honest, show me the equivalent of Microsoft in the UK or in Europe. They simply don't exist. So that's why we've got more of a lean into US type names. Although we cast the net as far and wide as we can, because we're global investors at companies in Europe and also Asia, which I think we'll talk about later on. Just with regard to portfolio turnover and the strategy, we often say that investing, well, we say it here, investing should be really like watching paint dry, and just getting out of the way of those types of companies to allow them to compound at very high rates of return. So our average portfolio turnover, how many times we've bought and sold businesses relative to the size of the fund, has been around 4%, which is pretty low. We've held businesses, the equities in the portfolio today for on average around 7 years, and over the 20 years over the life of the fund, that's been around 5 years. We believe in low turnover, but we don't believe in no turnover. That's an important point to draw out. This portfolio is an organic beast, and we're constantly trying to adapt and evolve to the changing environment. So what are the other parts of the portfolio? We often get questions on gold. And gold's currently about 11% of the fund today. And so this chart's showing you the defensive characteristics of gold when markets fall. And it's a very important insurance contract or policy in the Trojan Fund. And really it acts as a diversifier to the other parts of the portfolio. It is in its own right a store of value. It sits outside the financial system. It's no one's liability. And in periods of distress, much like last year, gold really shines. We've held this since 2005. It's compounded at about 11% per annum in sterling terms, and it was up 25% last year. So it really can contribute to the portfolio in times of stress. Just to our bonds, we hold about a third of the portfolio today in inflation-linked government bonds, predominantly in the United States, with very short duration. So the sensitivity to the interest rates is very low because we're nervous and we don't get paid or rewarded for taking excessive duration risk out on the curve. And so we have US TIPS, and they're linked to both the coupon and the principal payments are linked to the underlying US inflation CPI. And so that gives us that inflation protection, which is especially relevant in today's markets. The gray above that is just represented by short-dated UK T-bills, which provide the strategy with ample liquidity as and when we need it, much like last year when the coronavirus crash kicked in. On the current asset allocation, you can see, as I mentioned, we have about 40% in equities, about 30-odd% in US TIPS, and the balance in gold and liquidity in cash assets. Our equities are spread in a good range of sectors, both enabling change and adapting to change. So we're very happy with those, and the balance is in those protective assets. And you could argue this is a pretty straightforward, simple, balanced mandate, and we keep it deliberately simple, as I mentioned. We don't get involved in derivative strategies or protective strategies or anything like that. Cash really is the ultimate optionality for us in this strategy. And the box in the bottom right-hand corner, I just wanted to flag to everyone. It's quite an important one. We invest in liquid assets. And if we were to liquidate the entire portfolio, this particular strategy is almost £6 billion in size. It wouldn't take us very long to do that. And it's a really important point that if investors want their hard-earned money back, we make sure that we can, this is a daily dealing fund, we can give their money back as quickly as we can. And that's a really important point of the liquidity profile of this vehicle. And just finally, our objective is no less relevant today than it was when Sebastian and Lord Weinstock set Troy up 20-odd years ago. Without question, investing over the next 20 years is going to be very different than the last. But again, to reiterate what Henry said, some things don't change. The laws of compounding most certainly remain intact. If you lose less on the downside, but compound consistently on the upside, returns should be much better overall. And the ride should be a lot less bumpy, which we have displayed in the slides before. We need to respect and preserve what we have, where we come from. And I think the immutable principles of capital preservation remain at the heart of every decision that we make. It's really an exercise in risk management. Everything that we do, we focus on the downside. But we also need to adapt. Winning by not losing over the next 2 decades, as you will all agree, I'm sure, will entail a lot of challenges, but also a lot of opportunities. With that, I would like to take the opportunity to thank you all for your support and for listening to me this morning. And I'm looking forward to answering any questions that you may have. I'll hand you back to Henry now.
Thanks, Michael.
Thank you very much.
Yeah, we have had a few questions in already. As I say, we'll probably look to take them at the end. I've actually before we get on to that, I've got a few slides actually just to sort of look at where we are in the world at the moment, and perhaps I'll ask you for a couple of comments on that as well. I'm just going to try and share my screen again. Let me just do that. And again, if you could give me a thumbs up, Michael, if you can see that correctly on yours, great. Okay, yeah, so as I say, we'll take some questions at the end. I've just got a few slides I'd like to share, both to talk about what's going on at the moment, but also, again, look back to the past and learn a few lessons, because, as Michael said, it's an interesting time. Valuations certainly aren't cheap. The world's a very interesting place, as we know, at present. And some investors may be slightly cautious, but I'd also like to reflect on some of the principles of longer term investing in some of the slides I share. But before we do, just sort of looking at sort of where we are economically at the moment, most conversations around economies and markets start with one word, and that's inflation. And it's pretty easy to see why. If you look at the chart on the left hand side here, which shows the sort of main headline inflation rate, in the main economies. In the UK, the rate's around 3.2%. US, you can see, is far ahead at 5.3%, but both of those are significantly ahead of the central bank's headline target rate of 2% per annum. And that's really because the economic bounce back has been really strong, and demand has really picked up significantly from the lockdowns that we saw during last year. We know that commodity prices, energy prices have shifted upwards, and we've still got quite a lot of supply bottlenecks in the system at the moment, and that they've all contributed to prices sort of really rising. The labour market has been challenged as well with COVID issues continuing. Labour movement around the world has been restrained. We've had issues locally with regards to Brexit on that front. Indeed, other sort of global politics issues certainly haven't helped. So really quite challenging, sort of leading to this inflationary environment. But you can see with the dotted lines on the chart on the left-hand side, the expectation from central bankers and markets is still that this will fall back during next year. That inflation is still a bit transitory at the moment. One central bank, European Central Bank's board member, I've got a quote here from them. They said the current inflationary spike can be compared to a sneeze, the economy's reaction to dust being kicked up in the wake of the pandemic and the ensuing recovery. And I think you'll see, if that is the case, and after that sneeze, inflation does settle back down, but settles back down a bit closer to the 2% headline target, actually central bankers won't be too displeased. Actually, they've spent quite a lot of the last decade trying to increase inflation. So actually a healthy amount of inflation, but not excessive inflation, is quite a desired outcome from them. Furthermore, central bankers are also very much not just managing against an inflation target, but they're looking at an employment target as well, and looking to manage the economies towards full employment. And it's really actually this secondary objective, which is really in their focus at the moment, particularly given the support that the employment and labour markets have had from governments over the last few years, and when during the pandemic, and the tapering of that will occur, and is occurring now. So I think the expectations are that for now, inflation will be allowed to overshoot, and the expectations are that interest rate policy from central banks will remain relatively supportive. You can see on the right-hand side there, markets are only expecting some relatively minor rises in interest rates over the next few years. But of course, when we are talking about such low levels of rates at the moment, a 0.5% rise actually does and can make quite a big difference on a relative basis. We've also got to talk about debt, because as well as interest rates being at ultra low levels for the last few years, central banks have been using quantitative easing to a huge extent over the last, was it nearly 15 years now, post the financial crisis. This is shown on the left-hand side chart here, which shows the main central banks' balance sheets expanding really exponentially since 2007. And again, you can see more recently, really notably, in response to the pandemic. It's the unwinding of these balance sheets that will no doubt be, and has already been signalled to be, sort of the first step towards tighter monetary policy from central banks, rather than significant interest rate changes. And the other sort of debt consideration on the right-hand side is sort of government indebtedness. You can see, across the world, the majority of governments are at record levels of debt in issue at the moment, having borrowed their way through the economic turmoil of recent years. If you look at it, the US debt levels are about 133% of gross domestic product. The Eurozone's about 100%. And both of those are up really significantly from the sort of range of the mid-70s, probably a decade ago. Right at the bottom there, Japan's at sort of quite an eye-watering level of 250% of GDP. So that's obviously an issue that we are mindful of and considering within our sort of asset allocation decisions. Of course, debt levels have risen over the last few years, but the cost of servicing that debt hasn't really, given the ultra low rates and really supportive policies from central banks, which kind of means governments are much more dependent on central bank policy, and central banks actually keeping rates low than they have been in the past, and it creates an interesting conundrum for central banks. Whether they might be forced to pick between maybe living with slightly higher inflation, or higher borrowing costs that could potentially thwart growth. So really dealing with these levels of borrowing and central bank balance sheets in an orderly fashion is going to be critical to the performance of many asset classes really over the coming years. So probably one of the most major sort of issues we've got to face really. And I just wondered, Michael, I don't know whether you at Troy have sort of got any particular thoughts in this area about how that might pan out in the years to come.
Thanks, Henry. I agree with your summary completely in terms of the stress and the pressure that central banks are faced with regard to an orderly or even a disorderly unwind of the size of their balance sheets. I mean, if you look at the US, the federal balance sheet today, upwards of $8.5 trillion. That's almost it's almost double what it was back in 2019, and 10 times the size of what it was coming out of the global financial crisis. So they've put significant levels of debt onto their own balance sheet, and much of it more recently to support the government's policies to enact furlough and to support economies through COVID. The difficulty is, and again you touched on it quite well, with regard to the cost of servicing the debt, and there is more debt, and so therefore how far can interest rates rise? Not very far, it would be our opinion, given the level of debt that's outstanding. And so that backs central banks and governments into a corner, really. They can't really raise rates because they'll increase the cost of servicing the debt. So it's quite a fragile place to be. And that's why it's reflected in our asset allocation via gold, which really would protect you from monetary instability. But also our US inflation protected securities, which will thrive in an environment where interest rates stay very low, but inflation is allowed to run a little bit hotter. So really you have an environment of negative real rates. And that's the ultimate outcome of all of this. If you put too much debt into the system, you're trapped really, and you can't raise rates too high because you will destabilize the system. And we saw that back at the end of 2018, early 2019. The famous Federal Reserve Chair, Jerome Powell, and his pivot, where before Christmas, he said that the reduction of the balance sheet was on autopilot. And then immediately after Christmas, he turned around very quickly and retracted his statement and said that the Fed would be ultra accommodative. And the markets fell aggressively when they realized that there was no support there for them from the Fed. So it is a precarious situation, and it'll be interesting to see how it unwinds over time. But importantly, to the inflation point, Henry, that you made in the previous slide, a lot of the drivers of deflation that you saw over the last 10 or 20 years haven't gone away. So demographics, technological disruption, and we have even more debt now, which is a handbrake on growth. So really, we remain very, very open-minded to where inflation ends up ultimately, but those drivers haven't gone away, and they're really trying to pull inflation down. So that's really what I would say on those points.
Yeah, I think I'd agree. Yes, I mean things like automation and things like that are really going to be big drags on inflation over years to come. Yeah, as I say, it's going to be quite interesting how orderly these issues are dealt with. But I think the central banks certainly have learnt an awful lot, and their signposting now is very clear. Markets are given plenty of time to have notice of what intentions are. But it's certainly something we're very much alive to, and as you are in our asset allocation decisions. But got a slide, next slide, which is maybe just has a bit more positivity to it. So yeah, despite some of these concerns around indebtedness and things and inflation, actually there's quite a lot of positivity out there. We know here in the UK, we're dealing with higher COVID numbers, which is has a lot of sort of negative feeling at the moment. But generally, in terms of global economies, we are still in the process of opening up and normalization, and that's still expected to continue. And that is feeding through to economic growth. And that economic growth, as you can see on the left-hand side, is still projected to be strong over the next few years. On the right-hand side, we've got the current consensus estimates for global earnings, company earnings over the next 2 or 3 years, and you can see that by and large they're all expected to be, the growth in earnings is meant to be much higher than it has been over the last decade as well. Just like to point out, actually, Europe and UK on there. You can see the grey bars of the last decade. Earnings growth has been quite modest, and actually, the earnings growth we're expecting to be quite significantly improved over the next couple of years in these areas, and both of those are areas that we've been adding allocations to in our portfolios over the last few months. We've had a question come through about China, which is quite apt because it leads into sort of my next slide. Which was really to start to talk about the longer term investment sort of opportunities. Obviously, China, there's been a lot written about China of late, and there's been a lot of change happening in China more recently in terms of regulatory policy, which perhaps you can comment on in a second, Michael, if I can ask you to. This actually is a slide I wanted to put up because it's actually talking about some of the long-term trends we look to try and play in our investment decisions. So as well as looking at short-term forecasts for economies, we like Troy very much take a long-term approach to investment. And one of the long-term drivers of future growth over the next decade or so is very much China and broader Asia. If you look at the left-hand side, you can see China certainly has really grown in terms of a share of the global economy. But on the right-hand side, it shows there's plenty of room for further growth, not only from China, but also India, importantly, and other Asian economies. The right-hand side actually shows how many people are expected to essentially change class and move up in class over the next decade. And the number is, totals over 1 billion people projected to change class over this time, which generally should provide a massive stimulus effect to the world economy, as all of these people spend their newfound income levels for the first time. We've had a question through, as I say, about China, probably more around the current issues that sort of China's facing. As I say, regulatory challenges, been quite a lot around the indebtedness of the real estate sector. And I know Troy don't invest directly in China within your strategies, Michael, but I know you're probably still playing these longer term themes of the emerging Asian consumer. But would you like to comment on your views on China and how investable it is and what's going on there at the moment?
Yeah, absolutely. And thank you very much for the question. It's timely and relevant. Firstly, it remains to be seen whether or not we will have kind of a systemic shock from China, given what's going on in their internal property market. One of the interesting kind of fallouts from this has been how contained the debt levels were in China itself. Yes, they did have offshore dollar-denominated bonds, but they've been largely kind of contained in either high-yield bond structures, and you haven't seen that ripple through equity markets too much. So that's an important point to flag. So Henry just made the point that we don't invest directly in Chinese bonds or Chinese equities, but one of the reasons being that we place enormous emphasis on governance. And so when we looked at certain Chinese companies, we simply couldn't get comfortable with the governance levels, both at the company, but also at the country level. And what you're seeing more recently kind of doesn't prove our approach right, but it just reminds us as to, if you are investing in China, you need to be aware that these risks exist. And so looking at the underlying revenues of the Trojan Fund equity portfolio, we derive roughly 20% of revenues from across all of the companies come from that region, and that's largely from China itself. So we are accessing this kind of rising and emerging middle class who want to spend and who want to access various services and things that our companies provide. But just to step back on the regulatory side of things, you could argue that the Chinese Communist Party is actually taking what, on the face of it, look like some decent steps in trying to achieve their common prosperity goal, which is, I mean, if you're stopping kids from playing video games over 3 hours a day, is that such a bad thing? But also putting in the kind of regulatory controls in place to stop the financial IPO from happening is actually quite a sensible step, given the risks inherent in the business model that was about to be floated. So they are taking some meaningful steps. For the West, it's quite jarring how quickly they can happen. But from the outside looking in, some of the regulatory changes that they're making are seem quite sensible for the long term. But no, we don't invest directly, and regulatory concerns would be one of the things on the top of the list that we would be concerned about, and governance.
Marvelous, thanks for that. We obviously do have some exposure to China within our portfolios. I think we have a couple of funds which invest sort of in Pan Asia, including some Chinese equities. I would say though we are very happy with the skill set that we have there of the managers. I think when you're investing in these sort of areas, you really need good local experience. You need to know what's going on, and you need active fund management. And so whilst we do have some limited exposure there, we have it in the hands of some really good teams that know what they're doing in the region. Just going to flick on now, and just really got a couple of slides that I wanted to just show, just to again look back again over the longer term, and a few longer term investment lessons just to sort of finish off before we take a few more questions. This slide actually doesn't look back 20 years, it looks back 120 years. You know, these sort of slides hopefully are sort of quite useful when one's considering the headlines around inflation and the potential hard winter ahead of us. Investors who might be looking and, you know, almost feeling a little bit unnerved at times. Just a couple of slides that sort of should reassure about sort of staying the course. And again, I think Michael's presentation about the compounding effects over long-term investments, you know, really sort of emphasize that as well. So this slide goes back 120 years, and it looks at the adjusted real returns, essentially adjusted for inflation, from the traditional main three asset classes: equities, bonds, and cash. And in this case, we're looking at UK equities with the FTSE 100, the government bond index, and as I say, cash returns, all of which have beaten inflation over the last 120 years. But you can see, you know, this is a logarithmic scale on this chart, and you can see equities have done so far in excess of bonds and cash. Yeah, the value of £1 over that 120 years would be £2 if you simply held money in cash, £8 if you sort of invested in bonds over that period, but £380 if you invested in equities over that period of time. So yes, risk assets can compound and deliver really handsome returns and beat inflation, but investing in equities, you know, will and does come with volatility. Obviously, you know, hopefully you're reassured from Michael's presentation earlier that you know, the money is in the hands of really good asset managers who very much look to limit volatility and minimize risk. And you can see actually why, I think from Michael's presentation, why we view the Trojan Fund as such a key cornerstone of our portfolios, because of their mindset. But investing in anything with equity backing will come with volatility, and that should be acknowledged by investors. This chart helps to highlight that. This looks back over the last 35 years. And again, we're looking at the UK market here, the FTSE All Share, and the grey bars are the the total return from investments on a calendar year basis over that period of time. And again, you can see the significant periods of volatility we've already both talked about, back in the early noughties, in 2008, and again more recently. But 24 of 35 years, we've had good, solid, positive returns from equities. But the interesting point are the red dots on this chart. The red dots are the intra-year declines, that sort of period of drawdown Michael talked about, during that year, which shows that volatility is a very common function of markets, and something that one shouldn't be afraid of and scared of. Up until last year, really, we've actually had some relatively modest volatility in equity markets for a prolonged period, but volatility is normal, and a very common feature of markets. Indeed, actually, active fund managers that we use within our portfolios quite like a bit of volatility. It does create opportunities to exploit volatilities, and actually use sell-offs in markets to top up on some of their favorite sort of longer term equities that they might be investing in. So certainly volatility is something we should not be scared of, but acknowledge will exist at all times. The key to actually managing volatility is basically holding one's nerve when it arrives, staying the course, and investing for the long term. And again, this slide shows that sort of evidently. This looks back again quite long term. We're now actually turning to look to the US market, and it looks at annual time periods, rolling time periods going back to 1950s. And it's quite interesting. It shows the different range of outcomes that you could have seen if you invested over different time periods. So on the left-hand side of the chart, if you're investing with a 1-year time horizon, the grey bars are the US equity market. The greeny bars are bonds, and the blue is a sort of mixed portfolio. But if we just concentrate on equities, the best 1-year investment outcome for the S&P 500 would have been 61% gain over a 1-year time horizon. But the worst fall would have been a 43% decline. So that's quite a spread of outcomes over a 1-year window. And you can see, as you move to the right-hand side of the chart, if you invest over a longer time frame, the spread of returns narrows as you smooth out that sort of shorter-term volatility. So if you look right at the far right-hand side and invest with a 20-year time horizon, the worst outcome you would have had over any 20-year window during that period of time would have been a positive 4% annualized return, which still would have beaten inflation over that period of time. Obviously, the best outcome, there are better periods to invest than others. The best would have been an 18% annualized return. But you can see how, by taking that long-term mindset, you can certainly smooth out short-term volatility. And then finally, the other way that obviously one can look to smooth out volatility, more so in the short term, is diversification, which also helps with regards to avoiding the more permanent risk to capital. So investing in a diversified portfolio, whether that is as an individual fund, which is looking to diversify across lots of securities, or in our case, as a portfolio of funds looking to diversify across a range of different assets. This is quite a colourful and busy table, I appreciate, but just to sort of point out what it's showing you, it's looking at the returns from main asset classes over the last decade or so, and ranked in order of return. So the asset classes that have delivered a higher return at the top of the table on a year-by-year basis, and those who have delivered a worse return are at the bottom. So if you look at last year, for example, emerging market equities delivered a 15% positive return, largely on the back of actually China emerging from the initial impact of the pandemic quicker than all other economies, really. If you look at the bottom of that year, 2020, commodities lost you money, and real estate lost you money. Whereas if you look at the year-to-date column, which is basically the column next to 2020, last year's losers have been very much this year's winners. Commodities have been up over 30%. REITs delivering sort of 23% year-to-date to the end of September. So picking last year's winners is very much not a guide to next year's success. The best way that we believe in terms of navigating through the variability of returns is very much diversification. The white bars on these charts are a typical diversified portfolio with some equity backing, but some exposure to other assets as well. And you can see, you're not going to have any eye-wateringly bad returns in terms of relative returns. You might be giving up a little bit of eye-wateringly good returns when certain assets perform really strongly, but you can get good, solid, positive investment returns with good levels of risk management by creating a really good diversified portfolio. And that's very much what we aim to do here at SG Wealth. We aim to build long-term, consistent, diversified portfolios very much for the purposes of our clients' financial plans. We normally at these calls just share the returns over the last 5 years of our main risk levels of portfolios. Our blue is our more adventurous strategy, which is more equity focused. The turquoise, which has delivered a sort of a more modest 15% return, is very much our defensive and very cautious portfolio. Still aiming to deliver a return, still having beaten inflation over that period of time, but protecting capital very much at its core. If we just look at the red line on these charts, that's our balanced portfolio, our sort of most popular portfolio in terms of clients' assets, and that's both smooth returns and still delivered quite handsome returns over the last 5 years of in excess of 35%. Just for fullness there, the more flat lines are our benchmarks for our portfolios. So the silver line is the independent sterling balanced private client index, which we benchmark our own balanced portfolio against. And you can see that delivered just over 25% over the last 5 years compared to our portfolio delivering 35%. And that's what we're aiming to do with our portfolios. We're aiming to create well-diversified, solid portfolios that will give the appropriate level of risk and the appropriate level of return over the long term, but aiming to use managers like Troy and others to add value through their investment approach and blend all of that together in terms of our construction of portfolios and individual managers' management of the assets to deliver out performance. And I'm glad to show that this chart highlights that process has been quite successful over the last 5 years. So I think in the interest of time, I should probably leave that there and just move on to a few questions, because we have had a few questions come in, and I just wanted to ask you, Michael, because we've got you for a couple more minutes, I think, just on a couple of the questions that have come in really sort of aimed at yourself. First question we've had in is quite topical, is around ESG and sort of what level of involvement and due diligence around ESG criteria and things do you bake into your sort of investment process? And just if I'd like to just add to that before I hand over to you, perhaps also you might comment on the difference between the Troy Trojan Fund and the Trojan Ethical Fund, because we hold both of them. We hold the Trojan Ethical Fund within our more sustainable focused portfolios. If you just compare those two as well for us, that'd be great.
Yeah, no problem at all, Henry. I'll start there actually. So the Trojan Fund and the Trojan Ethical Fund are essentially the same vehicle in terms of asset class and asset allocation, and they're managed in the same team. So Charlotte Young is the primary manager, but she's in the multi-asset team. So if one decision is made on the Trojan Fund, it's typically made on the Ethical Fund as well. The differences are within the equity selection component of the Trojan Ethical Fund. So we have a negative screen that sits over our investment universe of 170 companies, and it strips out sectors such as tobacco, gambling, armaments, fossil fuels, things like that. And it came about in 2019 because investors wanted us to provide a Troy-like performance or pattern of performance but they didn't want to have to invest in things like tobacco and alcohol and gambling. And so we have that screen that sits on top. And also the gold with which we invest in has to be London Bullion Market Association 2012 compliant, and it's physically backed exchange traded funds. So the sourcing of the gold is responsible itself as well. And it's similarly, the sourcing of gold in the Trojan Fund is the same. So they're on the same level. But really, it's in the equity component, and the differences are minor. So in the Trojan Fund, we hold Pernod Ricard, and we also hold Diageo. On the opposite side, with the Trojan Ethical Fund, Charlotte would hold small holdings in things like MasterCard, and would hold other weightings to higher levels. So really, the differences are quite small. But the whole idea is that both vehicles will produce the same level of performance, or the same pattern of performance over time. And we've seen that in a very short space of time. Trojan Ethical Fund was very defensive last year when markets fell, much like the Trojan Fund. The Trojan Fund fell about 9 when markets fell about 30. Similarly, the Trojan Ethical Fund fell about 7 and quickly recouped those losses. So that's really the main differences. In terms of ESG integration, it starts from the word go with regard to our equity analysis. Troy has been on a journey. We've invested heavily in systems and resource. We have achieved an A+ rating from the UNPRI, which is a body of a couple of thousand asset managers that produce information on a yearly basis. And when we started out, we were getting B's and C's, Henry. But actually, over time, with the investment and the amount of work that we were doing, we started to shine a bit brighter on those types of external accreditations. So that's kind of very much a work in progress, and it's never done. We engage with all the companies that we invest in. We've signed up to a number of really important initiatives, like the Net Zero Asset Manager Initiative. And so to achieve a net zero target by 2050. So we're holding all of the companies that we invest in to account against that kind of strict timeline. And we're lucky in many respects. Our investment process means that we typically avoid a lot of those types of companies. So when I talked earlier about avoiding capital intensive businesses or cyclical companies, we don't invest in energy businesses, for example. And so we don't have to hold BP to account over their extractive oil practices, because we simply don't invest in them. But the businesses that we do invest have their own challenges. So if you think of something like a Nestle, who we spoke to last week regarding their biodiversity, and how they're approaching this, it's just fascinating. And they're really at the vanguard of change there. But they have to be, so one of the biggest producers and consumers of raw materials. But also regulation is coming, whether they like it or not. So they have to be at the vanguard, and they have the financial wherewithal to do it. So yes, we engage with all of our companies. And then finally, we vote all of our shares, and we're very active. And we communicate if we vote against management teams. So we recently voted against American Express for their remuneration policies, and they got in touch with us, and we had a big conversation with them about that. So you can make change, even if you're a boutique asset manager in London. You can make change, and so ESG is integrated in everything we do. And the ethical fund simply just has those screens as an add-on.
Great, lovely, thanks, Michael. Yeah, and just from our perspective, that's why we use the ethical fund in our sort of ethical portfolios, because we again, within our portfolios, we do the same screening. So it complements and sits in really, really well. Again, we're looking to maintain the same asset allocation, the same investment characteristics, but just with those ethical screens for clients who sort of want to use them. One other quick question. Well, actually, we've got 2 more questions we might take. Firstly, it's just as an asset allocation questions come in, just asking about whether you vary the asset allocation and how much you do so between the main asset classes. And I think just before I hand over to you, it wasn't sort of clear whether it was directed to yourself or us. So I'll just put our spin on it. From our perspective, in our investment approach, yes, we do as well. We start with a long-term strategic asset allocation target for our portfolios. We based around the level of risk we're managing our portfolios against. that does get reviewed periodically, but is based on a very sort of long-term assumptions. But within that, we also have then a framework of where we can flex that based on a tactical view on the world. And our tactical view on the world typically is a year or two out, looking at economic expectations. So we can flex our asset allocation based on how we see things going. So yes, we very much do that, but within some very controlled risk parameters. One of the reasons we use Troy, and I don't want to answer the question for you, Michael, is I'm sure you'll say that you do have a good degree of flexibility as well. And we like managers in certain areas, particularly like yourselves, to have some of that, because actually that adds an extra layer of flexibility within our portfolio. So with that, maybe you can just expand on that a little bit.
Yeah, I would just say we sit in the flexible investment sector. The fund has the opportunity to move in and out of asset classes as it sees fit. But over the life of the vehicle, we've really held on to those four pillars, which is equities, bonds, cash, and gold. And in times of stress, you'll typically find that the Trojan fund will really kick into gear as markets fall. We will be buying companies that we favor and increasing our equity weighting. And we often describe it as walking up the down escalator, and it's incredibly uncomfortable because markets are falling and people are getting very fearful. But you need to kind of stick to the investment process, which is your guiding light, really. And so in February and March, the multi-asset team deployed roughly 18% of liquidity into the equity market. And if you can cast your mind back to that moment, I mean, everyone was at home. So our dealers were doing that from their kitchen table. And Troy in that quarter traded more than they did in the entire year of 2019. And so we do move with dynamic asset allocation when we have an opportunity to do so. And then for very long periods of time, we typically just manage the asset allocation in a range. And so for now, we're very nervous of where markets are. So we have 40% in equities, where in the past, we've had almost up to 70% in equities coming out of the global financial crisis, when it was just a very different backdrop. And we were able to buy a Microsoft or a Nestle on very attractive valuations. Today is not the case. And so we're very nervous. And that's why our asset allocation is as it is.
Lovely. Thank you. I appreciate we have just overrun the hour, but I just want to fit in one more question, if we may. You can give it a relatively short answer, because I think I would if I was answering it. But the questions come in about whether cryptocurrency forms part of your asset allocation decisions. So, can you give us a quick view on that, please?
Yeah, it doesn't. And it's for a whole host of reasons. We hold gold as a diversifying asset class, which has the millennia of history behind it. Bitcoin's been around for about 12 years. It's had a very volatile life. It's fallen more than 80% in 3 different episodes over this tiny time frame. And so for us, it's just not appropriate for the capital preservation mandate that is the Trojan Fund. But we do watch it. We're fully aware of the technology. We've had experts into our office to tell us all about it, and to take us through it from the ground up. And so we're on top of it, but it's not appropriate for the Trojan Fund or for our investors.
Good. I thought you'd say that, because we certainly concur with that view as well. So thanks for that. So yes, as I say, we've slightly overrun. So I think at that stage we must probably bring this to a halt. As enjoyable as it's been. If there are any other questions from anyone, please just feed them back to your individual wealth manager, and we'll get back to you on those. May I also just send a reminder, everyone on the call will get a feedback form. It'd be great if you could complete that. That will ask you sort of about some thoughts, and also what sort of topics you might want to be seen in other webinars. So we really do value your feedback on that for next quarter's call. We've also got some other communications going out shortly. Obviously, this has been an investment focused call, but from a financial planning perspective, we expect there may be 1 or 2 things that we want to talk to clients about after next week's budget. So we'll be putting a budget update out by the end of next week. So look out for that in your inbox, as well as the feedback form. But before I go, just like to thank everyone on the call for your time today, and very much thank Michael for joining us today. I think it's really interesting. to hear your views on things. So thanks very much, Michael.
Well, thank you very much, Henry.
Yeah, hope you've all enjoyed the call, and I hope you all enjoy the rest of your day. We look forward to seeing you again soon. Cheers.